Welcome back to XRP Economic Radar, where we bring you the breaking developments shaping crypto markets in your portfolio. Today we're covering a story that has traders and analysts buzzing across the entire cryptocurrency landscape. A major industry figure is making a bold prediction that could change everything we've been experiencing over these past few months of market pressure. The claim is simple but massive in its implications. If a specific geopolitical event happens this week, we could be looking at the beginning of a massive bull rally that would lift not just Bitcoin, but altcoins including XRP across the board. The timing, the historical precedent, and the early market reaction are all lining up in ways that have serious investors paying very close attention right now. So stick with us because what we're about to break down could be one of the most important catalysts for crypto in 2025. And the details reveal why some are saying anyone holding through this uncertainty might soon look like a genius. The person behind this prediction is Simon Dedic, founder of Moonrock Capital, and he's not just throwing out hopeful speculation. His analysis is grounded in historical market behavior following the end of major geopolitical conflicts. According to Dedic, if the United States and Iran actually sign the peace deal that's been reported for June 19th, which is this coming Friday, it could mark the beginning of a significant rally across all risk assets. But here's the critical part for anyone watching this channel. Dedic argues that because cryptocurrency is the most volatile major asset class, it would be the first to benefit once the macro pressure from the Middle East situation finally eases. That means while traditional markets might see steady gains, crypto could see explosive movement as traders rush back into higher risk positions. This isn't just theory. Dedic points to concrete examples from history that show what happens when major conflict-related uncertainty suddenly gets removed from global markets. Let's talk about those historical examples because they're absolutely crucial to understanding why this prediction carries weight. When the Korean War ended, the S&P 500 gained 44% in the following year. That's not a small bump. That's a major bull run triggered by the removal of geopolitical risk. The same pattern showed up after the Iraq War, with the S&P 500 rising 25% in the year after hostilities ended. But it gets even more interesting. Dedic also highlighted that in 19 out of 20 conflicts that occurred after the Second World War, markets took an average of just 28 days to fully recover the moment hostilities stopped completely. Think about that timeline. We're not talking about months or years of slow recovery. We're talking about less than a month for markets to reprice risk and reward once the uncertainty clears. If that pattern holds true for the current situation with Iran, we could see a very rapid shift in market sentiment starting as early as this Friday. Now, Dedic did start his analysis with an important disclaimer that anyone following this story needs to understand. He openly stated that trying to predict anything based on what US President Donald Trump says or does is a fool's game. He even compared the president's unpredictability to that of his official Trump meme coin, which, by the way, has surged over 20% in the past week alone. But despite that unpredictability, Dedic argues that if the Iran deal actually gets signed as planned, the setup looks remarkably similar to previous moments when conflict-related uncertainty was suddenly removed from markets all at once. The key word here is if. Nothing is guaranteed in geopolitics, especially when it involves this administration. But the potential outcome, if this does happen, is significant enough that traders and investors are already positioning themselves just in case. The market doesn't wait for certainty. It prices in probability. And right now, the probability of this deal is high enough that we're already seeing movement. According to Dedic's assessment, the Iran situation has been the single biggest reason why risk appetite has been so suppressed in recent months. Just look at where Bitcoin has been trading. At the time of his analysis, BTC was sitting near $65,000, which represents a drop of almost 48% from its all-time high. And if you hold altcoins, you know the pain has been even worse for many projects outside the top tier. XRP, along with Solana, Cardano, and countless others, have been stuck in extended consolidation or downtrends as investors stayed defensive. But here's the thing that Dedic emphasizes. If that geopolitical overhang gets removed, crypto is likely to reprice very quickly because of how closely it follows changes in risk sentiment. Unlike traditional equities that move more slowly, crypto markets operate 24/7 and react almost instantly to shifts in macro conditions. That volatility works against holders during fearful times, but it works in their favor when sentiment flips positive. Dedic made a particularly interesting comment that probably resonates with a lot of people watching this video right now. He wrote that everyone who's been looking like an idiot for the last few months will soon look like a genius. That statement speaks directly to anyone who has stayed invested through this difficult period, who has kept holding positions while others panic sold, or who continued accumulating while the broader market stayed fearful. If this rally materializes the way he's predicting, those decisions that seemed questionable or even foolish during the downturn could suddenly appear brilliant in hindsight. It's a reminder of how quickly narratives can change in financial markets. One day you're underwater and doubting your strategy. The next day you're vindicated as prices surge and everyone wishes they had your position. Of course, that only happens if the catalyst actually plays out, which brings us to the confirmation that's driving all this speculation. President Trump himself confirmed what he called a great deal in a post on Truth Social, which gave the entire story significantly more credibility. According to market commentary from the Kobayashi letter, the proposed agreement would accomplish several major things. First, it would extend the current ceasefire between the involved parties. Second, it would reopen the Strait of Hormuz, which is absolutely critical for global oil markets and economic stability. Third, it would kick off negotiations around Iran's nuclear program, which has been a central point of tension for years. But there are also two additional components that have direct implications for financial markets. The deal will reportedly lead to discussions regarding the lifting of sanctions against Iran, which would reintegrate them into the global economy. It will also address the unfreezing of Iranian funds. And here's where it gets very interesting for crypto holders. That includes approximately $1 billion in cryptocurrency that was seized under Operation Economic Fury. The potential release of that much capital could itself be a catalyst for market movement. The market reaction to Trump's confirmation and the news surrounding this potential deal has already begun. And it's exactly what you would expect if traders believe a major geopolitical risk is about to be removed. S&P 500 futures climbed 0.8% shortly after the announcement. Nasdaq futures, which are more tech-heavy and tend to correlate more closely with crypto, gained 1.3%. But the real action was in digital assets. Bitcoin moved to its highest level in almost 2 weeks, breaking through resistance that had been holding it down. Ethereum climbed back above $1,800 after languishing below that psychological level since June 5th. There was only one brief moment on June 9th when ETH touched 1,700 before diving back under, so this move above 1,800 represents a meaningful shift in momentum. It's not just the top two cryptocurrencies either. XRP, Solana, and Cardano all posted notable gains following the peace deal news, showing that the risk-on sentiment is spreading across the entire market. Among the major cryptocurrencies, Hyperliquid had the strongest performance in the immediate aftermath of the announcement. At the time the original analysis was published, Hyperliquid was trading just above $68, which represented a 10% increase in a single day. That kind of sharp, explosive move is exactly what Dedic was talking about when he said crypto would be the first to benefit from easing geopolitical pressure. A 10% daily gain is enormous for any asset, and it shows just how much pent-up demand exists once traders feel even slightly more confident about taking on risk. Now, it's important to remember that one day of gains doesn't make a trend, and we've seen false starts before. But when you combine this price action with the historical precedent, the confirmation from the president, and the analyst predictions from credible figures like Simon Dedic, the picture starts to look much more compelling. This could genuinely be the early stage of a broader risk asset rally that lifts the entire crypto market. Looking at the bigger picture, what we're potentially witnessing is a textbook example of how geopolitical risk premiums get priced into and then out of financial markets. For months, the uncertainty around the Middle East has acted like a wet blanket on risk appetite. Investors have been hesitant to add exposure to volatile assets like cryptocurrency because the potential for escalation created too much downside risk. But if that risk suddenly disappears with the signing of a peace agreement, the entire calculation changes overnight. Money that's been sitting on the sidelines in cash or stable assets will start looking for higher returns. Institutional traders who have been underweight crypto will look to rebalance their portfolios. Retail investors who sold in fear will experience FOMO and start buying back in. All of that creates buying pressure that can fuel a sustained rally, especially in a market as liquid and momentum-driven as crypto. The historical data showing 28-day average recovery times after conflicts end suggests this repricing can happen very fast once it starts. So what does all of this mean for you as an XRP holder or someone interested in the broader cryptocurrency market? It means we could be at a genuine inflection point. If the US-Iran peace deal gets signed on June 19th as reported, and if the historical patterns hold true, we may be looking at the beginning of a massive bull rally across risk assets, with crypto leading the charge. XRP, which has been consolidating along with the rest of the market, could see significant upward movement as part of this broader shift in sentiment. Of course, nothing in markets is ever guaranteed, and geopolitical situations can change rapidly. But the setup is there. The historical precedent supports the thesis. The early market reaction is confirming the theory, and credible analysts are making the call. Whether you're a long-term holder, an active trader, or someone considering entering the market, this is a development worth watching very closely over the next few days. The potential implications are too significant to ignore. This is exactly the kind of breaking news and analysis we bring you here at XRP Economic Radar. If you found this information valuable, and you want to stay ahead of major market-moving developments, make sure you subscribe to the channel so you never miss an update. Hit that like button if you appreciate the detailed breakdown we just went through. Share this video with anyone in your network who needs to know about this potential catalyst for crypto markets. And definitely drop your thoughts in the comments section below. Do you think the peace deal will actually get signed? Do you believe we're about to see the massive bull rally that Simon Dedic is predicting? Are you positioned for a potential surge, or are you waiting for more confirmation? We want to hear from you. Thanks for watching XRP Economic Radar, and we'll see you in the next one with more crucial updates on XRP, crypto markets, and the economic factors that drive them.